In chapter five, we're going to be talking about the statement of comprehensive income mostly, which is just an extension of your traditional statement of net income. So, what goes into net income? It's all of the revenues, expenses, realized gains and losses that you had during the period, all of the things that increased your profitability, all of the things that decreased your profitability that actually happened. Gives you your company's bottom line net income. But another way to measure your overall income for the period is with comprehensive income. What is the difference between the two? And the difference between the two is realized. For net income, if you want to have, say, a gain on investment sale, you have to actually sell that investment. Same thing is true for a loss on investment sale. But for other comprehensive income, you would even factor in gains that aren't realized yet. So the difference between the two is really gap rules and timing. There's a bunch of rules in gap, expense recognition principle, revenue recognition principle extensions that say you can't recognize a certain item until a particular time. So you'll have things on your books that are carried at a value, and you know that there's going to be a pending gain or loss or adjustment to its valuation at some point down the road that's going to ultimately, at one point, affect your net income. But it isn't right now because it's not actually been realized. So for other comprehensive income, you factor in those things that GAAP won't allow you to put into your actual net income. And the big three things that are in there, which we're going to talk about multiple times in this PowerPoint presentation, are any unrealized gains on investments. So if you have an investment that has appreciated greatly in value, you can have that gain in your comprehensive income. Adjustments related to the benefits of your pension plan. When you have employees that get a pension and they contribute a certain amount of their paycheck to the pension plan every single period, you don't just set it aside in a pillowcase or whatever. You invest it in some kind of portfolio. And that goes up and down as time goes on. Typically, there's also some kind of service charges that go into having professionals manage your pension plan. There's rules about how those have to get amortized. But the adjustments to your pension benefits go into AOKI, even though you can't realize them in your gap compliant net income. And the other one is what they call translation adjustments. You'll have transactions that are denoted, receivables and payables, in foreign currency. And as exchange rates change, the actual amount of US dollars you're going to get from that transaction goes up and down with the exchange rates, which means you could have a receivable that you put on the books and you record the revenue at the same time months and months ago, and whatever currency it's denoted in, Canadian dollars, let's say that's gone down a ton since the against the US dollar since then. Well, now that receivable is really worth less value than it was when you put it on your books, which means that at some point when you eventually collect that receivable, you're going to declare a huge loss on translation adjustment. But GAAP says you can't declare that loss until the receivable is actually collected. So while it's pending, while it's waiting, you have a translation adjustment for known changes in the exchange rate of what you're going to actually receive. Goes into OKI or AOKI, if you will, other comprehensive income. If you need one overarching thing to think of to think about this, this other comprehensive income is what could have been. What could have been if you sold all of your investments? What could have been if your pension plan got rid of all of the assets it was holding on to and converted them all to cash? What could have been had you collected on all the receivables and paid off all your payables denominated in foreign currency during the period? Hypothetically, if you went through and you did all these things, GAAP would allow you to recognize all those gains and losses, which would give you a very different amount of net income than you actually would report. So, other comprehensive income is what could have been had you done all the items possible that would have resulted in changes to your bottom line income during the period. So, when you report your comprehensive income, you have two approaches that you can use. You can do it in one statement, which makes a very long statement of profitability, but it has all the information in one place. You go through, you list your things that go into your regular net income, broken down in a multi-step manner, and then at the bottom you would tack on all the elements of comprehensive income that causes your comprehensive income to be different from your net income. And it's the way that most companies report, But you still do have the option of doing it in two separate statements. So you'd have your regular statement of net income, everything that was actually realized during the period. Then you would have a separate statement, the statement of comprehensive income, that started with your net income from the first statement and then put all of those adjustments to it for all of the unrealized things that you had. Earnings quality is another important topic when it comes to reporting income statements, no matter if it's regular income, comprehensive income, what your formatting is, anything like that. People want to know, okay, this is your income that you had during the period, but how did you get there? Because you have two different companies that have the exact same amount of net income, but the quality of their earnings could be slightly different. This way that they got to those earnings could be in entirely two different routes. One big thing is, are the sources, excuse me, of earnings that you have regular, permanent things that are going to happen from period to period? Are they resulting from your core operations? Because if they are, then a reasonable person looking at your income statement could say, okay, this is going to happen next period, and the next period, and the next period. So if you reported $1 million of net income, and most of it was from, sales offsetting your normal operating expenses, that's something people can expect from period to period. What if you got a bunch of transitory or temporary components of your earnings? Gains on the sale of assets. When your company isn't in the business of selling equipment, like you manufacture product and you sell that instead, but you decide to get rid of some of your old equipment and it results in a huge gain, you'll have a huge spike, but one-time spike in your net income for the period. So a company that has $1 million in earning from permanent sources, there's much more consistency in those earnings than there's a company that's reporting $1 million in earnings where the majority of the components of those earnings are temporary in nature. So, as a recap, things that you would have that would be considered permanent earnings, things that occur every single period for your company's core operations, making sales, paying for the cost of manufacturing those goods, which you turn around and sell, your selling expenses, your sales commissions, advertising, etc., your general and administrative expenses, paying your administrators, paying all of your core utilities, paying for insurance, etc., even interest expense. These are things that you would have every single period for a normal company. What would be transitory or temporary? A gain or loss in the disposal of any long-lived assets you have, any type of impairment loss that you would have. What am I talking about with impairment loss? You have some item on your books, some asset that you have that loses value suddenly, becomes impaired, and then you have a massive impairment loss. Imagine you are making toys for children, and somebody somewhere unfortunately, had a thing where a child was injured by one of your toys. And then they went and said, you can't sell that toy anymore. It's dangerous. But you've got tons and tons of inventory of that toy, which is now unsellable. You would say that this is unsellable. You would say that our inventory is impaired. You would have a massive impairment loss, and it would lower the heck out of your income for that one period, but it shouldn't do it in the period afterwards or afterwards. It's a temporary thing. Any type of item you have that's not going to happen from period to period would be transitory or temporary. And one that is incredibly important for what we're going to talk about today is discontinued operations. Companies operate in multiple different segments and they also operate in different parts of the world. And sometimes things prove not to be profitable and the company gets rid of those. I remember when Disney decided they were going to have Disney World parks in like every country you can possibly think of. Disney opened up like 10 Disney Worlds in all but the two in the US and I think one in Japan and one in France, if I remember, went under or started losing massive money instantaneously. And after only a few years, they're like, nope, this is a terrible idea. We're going to discontinue all these international parks. Well, when they discontinued them, they sold all of the assets. They scrapped all the roller coasters, got rid of all of the, inventory they had there, all of the memorabilia you can buy, and they would have had a big effect on their discontinued operations when they disposed of those different parks. That's not regular. You're not going to be getting rid of something every single period. Let's hope not, or you won't be in business long. So, discontinuing operations and reporting what happened to your overall income as a result of discontinuing those operations and liquidating all the assets associated with them would be transitory in nature. One thing to always keep in mind is GAAP allows you to have a lot of leeway. There's a lot of spots in there where you can have multiple different accounting treatments for the same exact situation. Depreciation is the easiest one to think of. You are familiar probably with three depreciation methods, at least by now: straight line, double declining, units of production. Well, choosing each one of those is going to dictate what the value of your income is at the end, because they all result in different amounts of depreciation expense being recorded. Same thing's true for inventory, LIFO, FIFO, AVCO. Choosing from those three different methods can help determine what your income's going to be at the end. And every accountant knows this. They know that you can manipulate your numbers for the purpose of reporting the numbers that you want. And it's something that users of your information have to be very wary about, because they're going to make judgments based upon this. So there's a big distinction between creative accounting, using those standards in the way that you see fit, and straight up fraud, reporting things that did not happen, depreciating assets that you don't own to purposely lower your income, writing down inventory that wasn't actually impaired or that you never had in the first place. Things like that are fraudulent. That's how you end up going to jail. So when you are an accountant and you're bookkeeping for people's numbers, it's always going to be in your back of the mind that you know that using a certain combination of things is going to allow you to get to the end line, the level of net income or comprehensive income that's going to make your client happy. But maybe it's not the thing that holistically makes the most sense for your company. If you're a company selling perishable goods, if you're a food-based company, you should be a FIFO company. Things, food goes bad. So the first thing you complete should be the first thing out before it goes bad. It doesn't make a lot of sense to use LIFO for any perishable good that you're selling. But you know that using LIFO always results in the biggest expense, which means if you want to lower your income for the period to smooth out your earnings, you could use that. So there's always a trade-off in the judgment that you have. Whereas one thing conceptually fits the situation of the business better, and that's what you should be using. But also, there's always the potential to pick and choose from those different types of treatments that are allowed to get to the ultimate income outcome, weird thing to say, income level that you want in the end. So why would somebody do this? Why wouldn't you just go with the thing that holistically makes the most sense? And that's because sometimes accountants and management are motivated to do so by things external to the actual company. You had benchmarks for you. You expect a certain level of income during the period, and maybe you don't quite get there, but you know that if you change a couple of your accounting methodologies around, you would result in a lower expense and therefore more income, and you might hit that benchmark. No one likes to see a loss. Is there something on your books that you could put in there that would result in a huge spike gain to get you out of that loss for the period? It might smooth your earnings for the period, but it's not representative of your company's true financial position. What companies always want is an upward trend, but not a jumpy or huge spike upward trend. The reason being is the market stockholders are irrational. If your income doubles from year A to year B, they're going to expect it to double in year C, and that might not be possible. So if you have a way to smooth those earnings, like choosing accounting methodologies that let you recognize revenues, income over a long period of time instead of instantaneously, instead of having that huge 1 year jump of, say, an 80% increase in your income in 1 year, that's going to cause all your investors to want to see that again and again and again every year. You find a way to smooth it out. Maybe you increase it by 10% every year for 8 years instead of just 80% all at once. It might not meet the substance of what actually happened to your company, but it doesn't set unrealistic expectations by your shareholders. And then lastly, we're all motivated by our own bottom line. A bunch of higher ups at companies will have some kind of compensation in their contract with the company where they get a bonus. It could be based upon the company's income at the end of the period. I've definitely met people that were executives that got a very small portion, like 0.1, 0.2% of the company's bottom line net income at the end of the period. And if you're a big enough company, you could talk about one small accounting change could make a $10 million difference in your earnings for the period. 0.1% doesn't sound like a big number, but when it's 0.1% of, 10 million, that's an extra $10,000 bonus you got right there. just from choosing to do a different accounting standard. So there's always a lot of things that you have where you might not, in theory, what accounting wants to do is produce accurate, reliable information that fits the substance of what's happening. But you have these external factors, what might encourage people at the company, management, accounting staff, and everybody else to adjust the quality of the earnings, to manipulate their income a little bit to meet these other outside goals.